All right. So today we're going to be going over price and volume. That's one of the first ones in the series. So I wanted to explain just the basics of what price is. So all the price is the ratio between two assets. So say, for example, we got BTC and we got USD. Price is just the ratio between those. So it's how many USD it takes to buy a BTC. This means that both of those prices can fluctuate in relation to each other. The value of USD can fluctuate, and the value of BTC can fluctuate. Bitcoin, in this example, is what BTC stands for. And what we're looking at inherently with price is that ratio. But we're also looking at a balance and equilibrium between supply and demand. We're looking at an equilibrium where the market has decided collectively that this is what the asset is currently worth. Now, the collective decision isn't democratic in any way. It's based on supply control, and I guess demand control in a certain way too. During bear markets, it's more driven by supply, and during bull markets, it's more driven by demand. And what that means is that if someone has a lot of supply of an asset, they can sell it, and selling an asset makes price go down. That's inherently what selling does. Enough selling will always make the price go down, and enough buying will always make the price go up. How stable the price is based on how much liquidity there is, which means how much there is to buy and how much there is, how much liquidity there is to be bought. So it goes both ways, if that makes sense. Price is key to trading. Price is what you're speculating on. Trading is inherently a speculative endeavor, and what you're doing when you're trading is you're trying to guess, well, is the price going to go up or is the price going to go down? Now, investing is a little different. So for investing, you're looking at the long term, and you're perhaps looking at fundamentals as well as technicals, and you're trying to say, well, I'm going to buy it and hold it, and this is something that I'm investing in that I'm going to keep for a long term. When I say trading, I'm talking about either day trading or scalping, where you're swing trading, and what you're looking at it doing is buying something low and selling something high. And in order to do that, you have to have a sense and a way of determining whether or not that price is likely to go up or likely to go down. So price is key. And price, there's a lot of ways that price works, and some of them are more new. For example, we have Uniswap with AMMs and stuff like that. That's a lot different than traditional markets. So for traditional markets, if you look at these, you go on the exchange, you see patterns like this, and you see the price here. These right here are the asks and the bids, which we'll go into next video. We'll say this is ask and this is bid. And all that means is that that's what people are willing to sell for. That's what ask is. What they're willing to sell for and what they're willing to buy for here is bid. So the closest price that they're willing to buy for is the bid here. And this difference in between these two is the spread. The spread being the gap between the closest asking price and the closest bidding price. But that being said, whoever, I'll get a little bit more into supply control, and we're gonna move on to the other one. So whoever has in order to determine what the price of an asset is, you're looking at what the market has decided it should be priced at, and in doing that, whoever has the most say, it's not purely democratic. It's more oligarchic deciding the price when the market decides. And what that means is that whoever has the most supply and whoever has the most capital to deploy, or demand, aka so whoever has the most USD in the case of a Bitcoin USD pairing, those are who decide the price. Now there are other factors that can help. There's supply issuance gambits and stuff like that can help, but inherently that's what it is. It's decided by them. Now volume kind of plays into that a little bit too. Volume is how much the asset is traded. So price and volume are correlated and related in a lot of ways. And you want to be looking at volume every time you're looking at price, especially on traditional markets that use limit order books, like SEX, or I guess you can't call it SEX, centralized exchange. I pronounce it SEX in my head just because it's C. Anyways, so yeah, for centralized exchanges, you don't want to be, you want to look at volume. You don't want to look at just price. You want to make sure you're looking at volume as well. So always have volume on your chart. And what you're looking for is well, there's a lot of ways to do it really, but what you're looking for is volume to be coming in at key points. If price is going up on low volume, that could mean a couple things. That could mean that there's just no sellers. No one's selling it, so there's not much volume. It doesn't take much buy orders to be eating through those asks above. Because if you think about it, you've got these asks overhead where, just like this thing we had on here earlier, where we have these asks and we have these bids. And so as each time you buy, all these asks are just orders, right? So there's one Bitcoin. Oh, we don't need that here. There's one BTC here, right? And then above it, another, $20 up. There's another, 20 BTC, right? So what's happening is, as you buy, well, that part gets erased because someone bought it. So that's not an ask anymore. So the price is going up, right? And then as you buy again, once that gets bought up. So if there's less asks above, it just means that it's easier to make the price go up. If there's less asks above and more bids below, it's easier to make the price go up. But that's part of the liquidity aspect too. So once you get into size, that means that you're going to get more slippage on your orders, which is something we'll get into with some of the other like actual trading videos. But volume's important. Volume's something you always be watching. And another thing that is important is that all the indicators that you see people use that are used on TradingView and other sites, these technical indicators such as RSI, MACD, all that, they're only derivatives of three things. They're derivatives of price, volume, and time, right? So those indicators are just using what you already see on the chart. They might be good or helpful for you to look at and see. Sometimes RSI maybe can be helpful, but in trending markets, RSI is not that good. And in general, I think indicators are used as a crutch. The only indicators I really think that you should be using are moving averages, which is just price over time. And then, VWAP is pretty good. Volume weighted average price is a decent indicator. But as far as when you get into, the RSIs and some of these more advanced seeming indicators, just use them if you want. And if they work for you, definitely use them if you have a system that works with them. But keep in mind that all they're doing is they're a formula, and all the formula is doing is using price, volume, and time. So when it comes down to it, that's all you really need. And that's what I recommend everybody to, when they start, is just to use price, volume, and time. And when I say time, that just means that over time, price and volume is changing. So on a chart, time is just the x-axis, right? And then price is the y, that's price. And then volume will be a separate indicator where it's down at the bottom, right? So when you first start, I really recommend just to do that. And that's really all you need. And if you want some indicators, throw on some MAs, throw on some high time frame MAs, some 4-hour MAs, 1 hour daily. Throw those on at first. Don't get trapped into, when I first started trading, I was on TradingView all the time thinking that, there was some golden ticket, right? Where you could go and, you could find some indicator that would do it all for you, right? Maybe you will, but probably not. It's not worth your time. I wouldn't worry about it too much. Instead, just try to get the basics down. Look at price, volume, and time, which just means look at a bear chart and look at trend lines. Trend lines are helpful. Just shows where people are buying. When it comes down to it, the market is, and this is a little bit digressive for this topic, we're about to be done with this video, but when it comes down to it, all the market is doing is, all it is it's a mimetics. It's a form of mimetics. And what's happening is we have, levels that, especially less liquid markets, especially, like shitcoins and stuff like that. A lot of these markets don't even have APIs. Like you can't even use a bot to trade it, or you can, but you have to use interface, user interface or something like that. That's, not many people are doing. But hey, if you want to do that, you might be pretty profitable. But anyways, I'm digressing further, but with indicators, what the fuck was I even talking about? Okay, I was just in the video. Anyways, we'll get into it. We'll get into it deeper. All right.